I'm Doris. I'm here to show you about market updates today. The market sentiment has changed after the US released its CPI for June. The market is paying for the dollar smile theory, and the proponents are shouting the dollar is not falling. Stephen Chen, founder of the dollar smile theory and the CEO of the world-renowned asset management company Horizon SLJ Capital Limited, believes that the Fed seems to be winning the war against inflation without pushing the U.S. economy into a deep recession. This is a bad news for the dollar and may cause shocks in the foreign exchange market. As the expectations of a soft landing for the U.S. economy heat up, the dollar appeared to be under depreciation pressure. As the dollar smile theory points out, the dollar usually rises when the U.S. economy falls into a deep recession or strong expansion, while it lags during the period of a moderate growth, such as now. Chen says evidence of a weakening dollar due to moderate U.S. economic growth is already building as traders bet that the consumer prices have peaked after aggressive Fed tightening and the dollar falls to its lowest point in more than a year. Chen said the dollar depreciation trend will continue as the public debt burdens and economic imbalances drag down the value of dollar. He said in an interview, the dollar has always been overvalued and still it is. The dollar will soon return to fair value. I think the Fed will raise rates one more time that a soft landing can be achieved. It has been made clear this week that the collapse of the dollar can sweep through global financial markets with great speed, and an optimistic report on the trajectory of inflation in the U.S. has spurred on a rally in the currencies of countries such as Sweden, Japan, South Africa, and Peru. In Chen's view, euro versus the dollars will soon swoop to 1.2 over the next 6 months, up nearly 7% from the current levels, producing a new illusion of this momentum. West FOMC's collective view of inflation is revised. I think it'll happen soon. The dollar will depreciate at a faster rate, he said. There will no longer be cyclical support for the dollar. While the rate hike in July remains almost a certainty, the rapid pullback in price gains, currently only a third of its 2022 peak, offers the renowned hope that the Fed may soon end its rate tightening cycle. Traders currently see less than a 50% chance that the Fed will opt for further rate hikes after July. Market sentiment suddenly reversed completely. 2-year Treasury yields turned down, and inflation fell so fast that it unnerved the Fed. A week ago, the yield on the 2-year U.S. Treasuries topped 5%, and just everyone thought it'll rush to its highest level since 2007. Sentiment suddenly reversed completely, and now bond bulls are expecting it to fall to 4% or lower. Pendle Group Limited and the Fed Securities believe that the slower inflation will allow the Fed to cut rates earlier and deeper than the market currently expects, a prospect that should allow the 2-year rate to reach this 4% level this year. Data released on Wednesday shows that the U.S. Consumer Price Index (CPI) fell faster than expected in June, and core CPI inflation showed up to be 4.8% in June, the lowest level since 2021. It triggered a surge in the bond and the stock market, with the dollar falling, and the 2-year Treasury yields falling 13 basis points, their biggest drop since May, as investors lifted the bets that the Fed Reserve will raise rates again after raising rates this month. The bond sell-off continued on Tuesday. A softer than expected wholesale of price indicator PPI released on the same day sent to the short-term U.S. Treasury yield below 4.62% to its lowest level in nearly a month. Jerome Powell's preferred expectation measure, core services excluding rent, slowed to 1.4% for the 3 months. Experts said this highlighted the possibility that easing price pressure was sustainable. Inflation has been a big issue over the past year. But we have entered a new range, she said. She has been bullish on the 2-year treasuries, but because the Fed could cut interest rates sooner and more aggressively than official says, will also be beating market expectations. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.